So some people want to use an IUL policy as a tool for an infant banking strategy, and many people wonder if this can be done. And the good news is it can be done, but you need a uniquely designed IUL policy in order to make sure that you're accomplishing your goals. Jason Herring, our IUL expert, does this regularly, and he's going to talk about the issues that can pop up that can torpedo your infinite banking plan if you're not getting the kind of IUL policy that's designed for infinite banking. So we're going to dive into this example. Jason's going to talk about the things you need to know. Then I'll be back with some action steps if this applies to you. Take it away, Jason.
Hey, thanks, Steve. Hello, everyone. Jason Herring here, your IUL specialist, serving and helping you here at Insurance and Estates. Hope you're having a great day. So today, guys, let's talk a little bit about using the infinite banking concept with an index universal life policy. This is probably one of the most often questions we get here at Insurance and Estates from our clients, from our potential new clients, is it possible, right? Is it possible to use an IUL if you want to use the infinite banking concept? And the answer to that is absolutely yes, it is. We do it often here. We help a lot of people get an IUL started that want to use the infinite banking concept. But just like any of our concepts that we have here, and something that we preach to you over and over and over, you have to be very careful of the design, and you have to be very careful that you're working with professionals, with people that have been doing this for a while, that truly understand how to design this concept correctly to benefit you as the client. So the best way to really do that is to walk you through a case study, an example of a client that we had come to us here within the past year. And the first thing I want to do is make sure you understand how not to structure the policy, okay? So if you're out there and you're getting examples from other agents, other professionals, these are some things to look for to make sure that your policy is not designed this way. So if you'll notice here, we have a 36-year-old male that came to us, and he wanted us to implement the infinite banking concept, but he wanted to use an index universal life policy because he wanted to go and have the ability to go after larger returns than what the dividend from a mutual company would provide on a whole life chassis. Using the IUL strategy, we can protect his cash value with the floor that's built into these products at 0%. But with a lot of these products having some type of a cap of somewhere around 9, 10, 11%, this client has the potential to go after larger gains than a dividend with a mutual company with the whole life chassis, but they also have their downside protected, right? So if you're trying to decide between, do I use a whole life strategy or do I use an IUL strategy for infinite banking, a lot of it is going to be built around your goals. How soon do you want to start taking cash value? What is your risk tolerance? What are some things that you're looking to do with these policies right away? Maybe do you have a little bit more time to let the cash value grow? All of these things, we'll have a conversation with you. And if it looks like that you're more of a whole life client, then we can definitely, move you on to some of the people that we have here on our team that focuses a little bit more on the whole life side. But I want to start today with showing you what not to do with your IUL if you're going to use IBC. So this client came to us. They wanted to do a $25,000 annual premium. So let's say this agent just goes out and decides to kind of jack the death benefit up a little bit to help the agent out. And we start with a $750,000 death benefit. So what does that do to the cash value? Well, we're doing a $25,000 annual premium. And if we come over here, we're going to base our returns off of a 6% average rate of return for all years. It could be higher, it could be lower, but over the life of the policy for this 36-year-old, we're looking at about a 6% average rate of return. So at the end of 1 year, this policy has about $19,606 available as policy value. But what do we know about cash value in an IUL that I've shared with you over and over in other videos? We can only borrow from the net surrender value. So this client, if this client has any opportunity or any desire to take loans within the first year, there's nothing available to them there. You can see there with the net surrender value being 0. Let's go out to the end of year 2. At the end of year 2, we've built our cash values up to $41,559, but we still only have $18,287 of surrender value. So less than half of our policy value is available at the end of year 2 for loans. So to me, this design doesn't speak very well, or it's not a great design for infinite banking, because the whole goal with infinite banking is to have maximum early cash value, right? To have as much cash value as possible early so that you can take loans, that you can put this cash value to work for you. So this would not be a design that you would want to implement for infinite banking. And these are some things that you need to look out for. When you start seeing these zeros in the first couple of years, you know that this policy has not been designed correctly. So let's take a look at how we did design this policy for this client. So instead of using a $750,000 death benefit, we actually solved for what's the least amount of death benefit we have to purchase based off of a $25,000 premium for a 36-year-old healthy male. And now we've reduced that death benefit all the way down from $750,000 to $494,000. So look what that reduction in death benefit has now done for this client. We're still planning to do a $25,000 a year premium. And at the end of year one, based on a 6% rate of return, we've increased our cash value from $19,000 to $22,000. So not a big difference in the addition of cash value there, but look at your surrender value. Look at what's available to you for loans. In the $750,000 example, we had zero cash value available at the end of year one. Now we have almost $16,000 available. Let's go out to year two. $46,000 of policy value, over $40,000 of that is available now for loans. So you can certainly see that it is extremely important to design this concept properly if you're planning to use an index universal life policy for the infinite banking concept. And if you look at the way this is structured, to take it a step further, most of the times when we're designing a whole life policy for infinite banking, there's a certain amount of money that needs to go to the actual cost of that policy. And then the rest of that premium that you're paying is going into the paid up additions rider, which essentially creates your bank and where you have money from early available for loans inside of that whole life policy. Most of the time we're looking to try to do some type of like a 60-40, 70-30 split, meaning we only want to use about 30% of your premium for the actual cost, and we're trying to place about 70% of your cash value into that paid up additions rider, into the bank portion of your policy. So look what we were able to do here that mirrors what we can do with a whole life policy. We've got a $25,000 premium, and at the end of year one, not even looking at policy values, let's go out to what's actually available. If we want to kind of compare apples to the whole life strategy, we've got $15,940. So roughly at the end of the first year, based on a 6% rate of return, we have about 64% of your premium is available for surrender value. So for the people out there that say you cannot use index universal life for the infinite banking concept, they're just wrong. They are. Is it always the best chassis to use? No, it's not. That's why it's so important to work with professionals that are going to ask you questions, that are going to listen to your goals, and then they're going to make recommendations for you based off of your goals. That's what we do here every day. Either myself or somebody else on the team, we're gonna talk to you. We're gonna figure out exactly what your goals are, and then we're gonna give you the recommendations that are gonna fit your goals.
Awesome. So Jason compared two different policies. The first one wasn't going to work because of the surrender charges. This is huge, especially if you want to make use of cash value in the early years. You wouldn't want to start up an IUL policy and then find out that there was no cash to be utilized in those early years. So Jason talked about adjusting the death benefit down. He was able to get more early cash value that would be conducive to an infinite banking strategy. So great job, Jason. Just what you need to know if you're interested in infinite banking with an IUL, talk to somebody that knows what they're doing. You can schedule a one-to-one with Jason wherever you're watching. There's going to be a calendar link. I encourage you to look at your own numbers. If you're interested in this, take the next step. I'll see you in the next one.